Yes? Okay, so hello everyone. Let's start. So we've done some of our capital investment decisions, right? And we stopped, I believe, on this slide. So let's start. Let's keep going because we need to. We need to get moving. We have a lot to do today. So this chapter, just as a brief, this chapter has somewhat more formulas. Oh, I'm showing everything it has kind of more formulas than usually, but treat them as your basic definition of whatever is calculated. Okay, it's easier to understand this way. I'm thinking to allow you to have some formulas on the exam because these three chapters are heavily I think you're not gonna remember all of them. So I will allow you to see that list, but that list is all you're going to be able to use during the exam. All right? Okay, can you remind me, did I promise you to post anything that I did not post? Did you see I posted a couple study guides, yeah, for the exam? It's already up there. There is a folder that's called Exam 2, and there are two files in it on Blackboard. And one has a study guide, the other one has a somewhat a set of formulas, definitions, and concepts, all right? Okay, so we stopped at criticism of the payback period method. So let's move on. We're going to talk right now about rate of return. Yeah, we're good. All right. So what is the rate of return and why do we need this? Practically, your rate of return, just from the definition itself, it's going to tell you when and how you can get your money back, the money that you've invested in something, right? In whatever asset you purchased for the company. So the basic definition is rate of return measures the average accounting rate of return over the asset's entire life. So what's taken into account is the entire life of whatever asset you've invested in, all right? So it's a measure also of profitability, okay? And from the formula, you're going to see that it focuses on the operating income. So what is the rate of return? Rate of return is your average annual operating income from an asset divided by average amount invested in that asset. So what are these two components? Let's talk a little bit about them. So average annual operating income, all right, that's your top portion. Average annual operating income is your asset's total operating income over the course of its life, okay, divided by the lifespan. That lifespan is measured in years, all right? So if expected lifespan of that asset is 12 years, you're going to be dividing your total operating income by 12, all right? So what is the average amount invested? Right, on the bottom, we have average amount invested in the asset. That's your net book value at the beginning of the asset's useful life, all right, and at the end. So you sum those two up and you divide it by 2. That would be your average amount invested. Okay, it's an average. Your beginning of net book value and your end net book value of that asset's useful life. You sum those two numbers together, you divide it by 2, you get an average. Yes?
Why?
Why what?
Why does that equal the average amount invested?
you want to, well, that's how your rate of return is going to calculate. You're dividing one average by another, all right? The first average is your annual operating income. We said that rate of return focuses on operating income, okay? So you'll take your operating income from that asset, derived from that asset, right? And you'll divide it by whatever average is invested, all right? And that's how you find your rate of return. So to find your average amount invested in that asset, you'll take your beginning of life net book value and the ending net book value, right, of life, ending of the lifespan of the asset. You sum those two numbers together and divide it by 2 because you want to have an average, okay? If you take just the beginning of assets useful life, that's too high of a number. It's not really representative, right? So what we're going to do, we'll use the average, okay? Another way also to say what we're doing here, we take, think of the other way I thought about this is if you look at the net book value at the end of the asset's useful life, it's like it's somewhat of a residual value. So what you're taking, the cost plus residual value, you sum those two up and you divide them by 2, okay? And that would give you a true average of the amount invested. All right? Okay. So let's look a little bit more at the rate of return. So here I wanted to show you how it's usually calculating. When we calculate our average annual operating income, right, from asset, these are the components that we are going to utilize. So first is our total net cash inflows during operating life of the asset, okay? Then what are we going to do? We'll subtract our total depreciation during operating life of the asset, right? That's, like I said, it's a cost minus residual value, really. And therefore, we're going to get total operating income, okay? That's our top, Yes, total operating income during the lifespan of the asset, okay? And then next what we're going to take, we'll take our assets operating life in years, right? Like we said. It might be 12 years, it might be 6 years, whatever is that lifespan. And that's how we're going to get this bottom part, average amount, Yes. What am I saying? Hold on a second. Yes. First is the first one. Let's talk about the first one. And that's how we're going to get our average operating income from an asset. So let me show you an example. Sorry, I might have confused you. So first, so let's say we have this total net cash inflows during operating life of the asset. We're saying that it's $60,000 for 6 years. So the total, we just multiplied those and we got $360,000. Okay? So what are we going to do right now to calculate our average annual operating income? We're going to subtract total depreciation during that lifespan of an asset. Okay, so we said that we first invested $240,000, and let's say there is nothing really left at the end of that lifespan. Okay, that's it. So our salvage value is going to be 0, but the cost that we initially invested was $240,000. Okay. So we calculate our total operating income during operating life of the asset, and that's a subtraction of the two. So $360,000 minus $240,000 is $120,000. And now what we need to do, we know already how many years. We said in the very first line, right? We multiplied 60,000 by 6 years. So we know the life expectancy of that asset is 6 years. So we're going to divide by 6 years. And 120,000 divided by 6 is the average annual operating income from asset of $20,000. Okay, so this is an example how we're going to calculate the top portion of this formula that I showed you on the previous slide, rate of return, right? Rate of return is average annual operating income from an asset divided by the average amount invested in that asset. So right now, what we're going to do next is we'll try to calculate that rate of return. So what we know, we already know how we found that $20,000, right? What we need right now is to understand where the bottom comes from, right? We said that the bottom is the average amount invested in the asset. And I just told you that that amount that we're trying to salvage is a zero, right? Just given to you. It's going to be given to you, all right? So right now we invested $240,000. We have a zero at the end of 6 years. What I'm going to do, I'm going to sum those two up and divide by 2, all right? All right, so I have 20,000 divided by 120, right? Another thing that I want to remind you, this is my net book value, right? This is in the beginning of the life. This is at the end of the life, okay? So 120,000 is what I'm getting. So 20 divided by 120,000 is what? 0.167 or 16%, 16.7%, okay? So just for you to understand what is this rate of return of 16.7% is if the company, let's say when they're making their managerial decision to purchase this asset or not to purchase, and they see that they must have a rate of return of plus 20%, they would reject this option. And they would reject it because 20% is what we need to get back from that asset, and from this calculation it's only 16.7, all right? All right. Okay, before we move further, again, what I wanted to point this. So this amount is what initially is invested, right? That's your net book value in the beginning. And this zero, or might be another number a couple weeks from now, that might be another number. It's not necessarily a zero, right? That number is the net book value at the end of the lifespan of that asset, okay? Just underlining it. All right, so let's move on.
Excuse me.
Yes?
Zero, it is the residual value, but because you said it's the net book.
Mm-hmm.
It's the residual value.
It's a residual value, but we also see it as a net book value in the beginning and net book value at the end, all right? All right, so let's look at this. Let's look at this. We've gone through some decision rules last class where we are, as managers, we're trying to make a decision. Should we invest or should we not invest? Should we accept that plan or reject it, right? So we're again at this decision rule schema. All right. So let's see, do we need to invest in capital asset, in this particular capital asset or not? So the way we're going to make the decision, we're going to look. If the expected rate of return is exceeding the required rate of return, then we're going to invest, right? From the example on the previous slide, we saw that it was less than, okay? So here's how we're going to decide, invest or not. If the expected rate of return is less than the required rate of return, as it was before, 16.7 versus 20, right? We're not going to invest. All right, so before we do the exercises, let me just remind you that both our payback period and rate of return methods, they're simple, okay? They're simple. They're not that difficult to calculate. They're usually the first tool that managers are going to use to either decide or decide for or reject a certain investment, okay? It's one of the first to screen out those undesirable investments, okay? But as we see a little further, what we're lacking here is the time value of money. So before we get to the time value of money, let's look at the exercises. So first one is S21-2. So we have two rates that we've just learned. It's our payback period and rate of return. So let's see how we're calculating. All right. So Smith Valley Snow Park Lodge could use capital budgeting to decide whether the $13,500,000 Snow Park Lodge expansion would be a good investment. So they developed some estimates, their managers developed some estimates, and using the straight line depreciation and expecting the lodge expansion to have a residual value of $1 million at the end of a 10-year lifespan. So here's what they have. Their number of additional skiers per day is 117. Average number of days per year allowing to use that skiing facility is 142. Useful life of expansion is 10 years. Average cash spent by each skier is $236 per day. Average variable cost per skier per day, $76. Cost of expansion, we just mentioned, and discount rate is 10%. So what I want you to calculate is first the average annual net cash inflow from the expansion, the average annual operating income from expansion, payback period, and the rate of return. So this is going to be painful because it's been, 2 weeks? But let's try. Okay? So I'm going to give you 10 minutes. Think about this. Go through your notes so that you remember what we talked about. Hopefully homework reminded you of something. You remember the homework is due tomorrow, right? All right. Try. Try whatever you can. Okay, I'm gonna show you one thing. Yeah, what? Someone? Someone said, no? Oh, I'm sorry. That's right, none of you have the book. Some of you do not have the book. All right, so we're gonna start with the average annual net cash inflow. So the first thing you want to calculate is average net cash inflow per skier per day. That has two components, right? Go ahead. No, that's it. I'm not going to say anything. So just from thinking about this, your net cash inflow should be a difference between whatever cash is coming into the business and whatever it costs you, right, to maintain this happy whatever day spent at the ski resort per customer. And then once you figure out what it is per day per skier, we'll take that number and we'll multiply it by all the additional skiers that are there at the resort. Okay? And then once we have that number, we know all the skiers, additional skiers per day, whatever that cash inflow, right? We'll take that number and we'll multiply by a number of days a year. So I'm like walking through you. Yeah? All right, so let me help you. Anyone has the number? Pete, Ben? No?
Final answer?
Yeah?
No way.
Anyone? Okay, so let me help you here. So we know that our average cash received from each skier per day is $236. That's given, right? We also know that there is a variable cost. Each skier, each day costs us $76. So what we just figured out is our average net cash inflow per skier per day. And that's $160. Right? So what did I say we need to do next?
Multiply that by how many?
That's right. You're right. So we multiply that by 117. That's how many additional skiers we have if we make that investment, right? So what we have right now is our average net cash inflow per day. So all those additional skiers that are right now visiting our, whatever that facility is, right? Right now we're making additional $8,720. Okay, so right now we also know that it's 142 days per year that we're making that additional amount, right? So we multiply 18,720 by 142, and we get this average annual net cash inflow per year of 2,658,240. All right, so let's leave it at that. Now let's try to calculate the average annual operating income from expansion.
You're going to put this part of the PowerPoint on.
As soon as we're done with this. Okay. Any guesses? No, no guesses. Anyone? I'm sure you remember. Yeah?
So you have to multiply that by 10 first.
What?
The average annual net income or net cash inflow per year.
So we take 2,658, 2 million, I'm sorry, 240, and we multiply it by?
Is the lifespan 10 years?
Yeah. So what is the number? What are you getting? If you multiply it by 10, what would you get?
26,582,400.
You're right that we're going to use this 10 years somewhere, but do you remember that formula that we said?
Well, your formula was that you multiply it by the lifespan first, and then subtract cost minus residual, and then divide by the lifespan.
That's what you're going to do. So you're going to take the average annual net cash inflow per year, okay? And then you'll calculate this yearly depreciation. Okay? So what is it? What did it say? I don't have the problem itself. Let me go back. So we know that the cost of expansion, right, is $13.5 million. Right? We also know that residual value at the end is $1 million, right? And then we also know that it's 10 years. So what we're going to do here, we'll take $2 million. Yeah.
Go back, multiply.
Uh-huh. Yeah. I think I see what's the deal here. Uh-huh.
You took the cash inflows and took life.
But we're calculating here our average annual operating income. Right? So do you see what I'm doing here? Total net cash inflow during operating life of the asset. Subtract total depreciation during operating life of the asset. Right?
Okay.
And then we divided it by the number of years, and we get our average annual operating income from the asset. And the way we find our total depreciation during that life of the asset, we take the cost and we subtract whatever we, right?
But you take the net cash inflow, and you have to multiply it times the lifespan. You're not doing that for the problem that we're doing right now. You understand? You see what I'm saying? Go back. Do you see how you multiplied 60,000 times 6 years?
Yeah, I see what you're saying. I see what you're saying. I see what you're saying.
Because if you don't do that on the problem that we're doing now, you're going to come out with a negative number.
I absolutely agree with you. It should be multiplied by 10.
Yeah.
Yeah, it's definitely not multiplied by 10.
If you continue to do it like that without multiplying it, you're going to get a negative.
Yeah, I agree with you. Okay, do you see, interestingly, last semester no one noticed that. Hold on. Yes, let me see. Something is up here.
You're asking about the net cash inflow compared to the total depreciation, right? You know, like I'm giving it a negative number.
What I'm saying is we're calculating a number that you're going to get as total net cash yearly, right there, per year. But the lifespan is 10 years.
So just from the formula, this should be by 10.
Yeah, it would be the same that you would need to multiply by 10 if you do total depreciation, but you're not. You're using only yearly depreciation.
Oh, that's right. That's right. That's right. You got it right. That's the difference between the two formulas. Good job. You got it, right? So here's the catch. Here is the catch. I'm not going to do that. That's just mean. All right, so the difference between the two, we're calculating here annual operating income from the expansion, right? But we're using the yearly, per year average annual net cash inflow and the yearly depreciation. All right. Let's not go nuts about this. Next. So the way we calculate our payback period for the expansion, that's where we're going to use that formula. All right? Our somewhat. Our payback period is the amount invested divided by expected annual net cash inflow. Okay, we know the amount invested, we know the net cash inflow, we just calculated it. So when we divide two numbers, we get that 5.1 years is what we need to pay back whatever we invested, to get the money back, okay? So the last one is our rate of return. So rate of return is what I want you to calculate. That's the one where we're going to use the normal formula. Payback period is whatever you had to pay it up front, right? And whatever that expected annual net cash inflow. So you divide two numbers and you get some number of years. All right. So our rate of return, we just learned how to calculate that. So use that formula and tell me what do you get? What number of percent? Any numbers? Yeah.
And this example would be like how you did it initially.
Yes. No, that's not it. It's the same formula as on accounting rate of return on that slide. So here's what we're going to do here. We'll take, where did we calculate this? So the very first value that we calculated, 2,658,240, we'll subtract our, I believe this is initial. No, it's not initial. Let me go back. So you're going to use two numbers here. The first, the one that we calculated, number 1, and then the second, that's your depreciation, yearly depreciation. And then we're going to divide by our investment. We'll add $1 million, which is total depreciation, and divide by 2. Okay? That's going to give us the difference, the relationship of our annual operating income to amount invested on average. All right? So the formula that you're going to use here, because you're calculating the rate of return, right, the accounting rate of return, that's your initially invested amount, and then whatever is that depreciation during the lifespan. So what we need to do is to make sure when you're calculating, you understand which formula is asked. Okay, so here you are using your accounting rate of return. And that's the very, very last slide that we went over. Okay, we'll have to do, I guess, more on this, okay? All right. So let's look at the rate of return was more than I expected. All right, I'll make sure that we have, during the review, that we have something to go over on this. given it's on the exam. But even if it's not, maybe I'm going to do this. Stanley, can I borrow your pen? All right. So like I said before, unfortunately none of those are using the time value of money. So what we need to do right now is to understand how do we use this time value of money concept to compute the present and future value of the single lump sum and annuities. What these words are, we'll go over right now. All right, so just thinking about this, when we invest $1 today, it's not going to be the same amount in a year, right, or in half a year, or in 4 years. And the same is true, invested something 2 years ago, that dollar 2 years ago is not quite $1 today, right? So for that, we want to understand what is time value of money. What is it about? But also you can earn extra income, right? So when you invest something, some amount of money, you can actually earn another amount of money on that investment, right? All right, so invested money earns income over time. All right? So that makes us understand that the timing when we invest an amount of money that we've earned, right? Hardworking, earned money, we want to make sure that when we're investing it, it makes sense and it brings us additional income. Okay, so this is very important. And there are two methods that we're going to use, the net present value and the internal rate of return. All right. So let's look, what are those factors that affect time value of money? There are 3 factors that we will talk about. The first one is our principal, which is amount of investment. So there are 2 types. One is a lump sum, and the other one is annuity. And we've just talked about those 2, right? So what is each one of them? Lump sum is just a single quantity of money, okay? It's as a lump, one amount, one large amount of money. What annuity is, it's a stream versus just one lump. Annuity is a stream of equal installments at equal time intervals. All right? So the second factor is the number of periods. So from the beginning of that investment until termination, there is a number of periods that time period is dissected into. All right? That can be months, that can be years, that can be quarters, right? All right, and the last one is our interest rate. So that interest rate is whatever that annual percentage that's earned on investment. And we'll learn there are 2 types, simple interest and the compound interest. So what is, just to remind you, I'm sure you remember this, but just to remind you, what's the difference between the simple and the compound? The simple one, do you remember? What is the simple?
So like 10% with the simple interest, 10% interest on $100 would mean you have to pay $10 year after year after year.
That's right.
Versus compound interest, you have to pay 10% on $100, but then there'd be $110, you have to pay 10% on $110, and then X and X.
That's right. You're right. So simple interest is only calculated on the principal, okay? So whatever was the principal, whatever was paid in the very beginning, that's the interest that you're gonna be getting off. Just of that, if it's $100, like you said, it's just gonna be calculated on that principal of $100. When we talk about the compound interest, there is an accumulated interest that's added to that principal, okay? And from that, we're paying 10% on top, okay? Earning, sorry. If that's something we're earning, okay? All right. So let's look, yes. All right. So simple interest calculating only on the principal amount. Compound is on the principal and on all previously earned interest. All right? So let's look at the a little bit closer at the compound interest. We assume that all of that interest is that we earned will stay invested, okay? And whatever is the additional that we're earning, like we just said, it's still 10%. It's the same interest rate. All right, so let's look at this. So capital investment yields compound interest. I think there's more. Yes. So we're going to assume that compounding interest is what we're using for the rest of the chapter. All right, it's not going to be simple. It's going to be compounded. So let's look at the example. One, just first couple lines. Let's look at them. So the first one, we have simple interest. What we're doing, we take $10,000, and if it is at 6%, we say that simple interest is $600. So for the second one, at 10,000, second year, $10,000, 6%, we're still earning $600. But now let's look at the compound. Compound is a bit different. The first line is exact same thing. The first year, it's going to be just as simple. 10,000 multiplied by 6%, it's $600. But the second year is where we see the difference. It's our 10,000 plus the 600 that we earned in the first year, and then we multiply that by 6%, and that's how we get 636. Now what's happening third year, we'll take 10,000. Now what are we going to do? We'll add both previous years, right? One is for 600, and the other one is 636, because we're in the year 3, right? And that's going to give us 674. Now, do you think you're going to be doing this crazy calculation? Absolutely not. We have tables that we will be using, all right? So this is for you to understand what's happening behind the scene, okay? This is how we calculate the compound interest. All right. So another good illustration for you to understand the difference between the present and future value. Okay? So let's say right now we're right there where it says present value. Okay? This is our timeline. And this is somewhere in the future we have some future value. So let's look, how do we calculate this? Our future value is in fact the principal, whatever it is invested as a principal, right? And whatever was interest earned. So how do I find what the present value is? I take my future value and I subtract my interest earned. Okay? So your present value is your principal. So if we're talking about, let's look at the numbers. Our principal, we said, is 10,000. Hypothetical interest earned 3,383. Okay, that's from the past slides. Let's not focus on this. So we calculate that the future value, if we invest this $10,000, is $13,383. For me to calculate my present value, I'm going to take future value and subtract interest earned. All right? So all that there is a difference between the present value and the future value is just the interest. That's it. All right? So here's the relief. Those factors for future and the present value are all calculated mathematically, and they are presented in the form of tables. You have those tables. You have them in Excel, you have them in the calculator, and you have them in Appendix B in the book. That is also going to be given to you during the exam, obviously. All right. Okay. So how do we use our future value factors? Okay, how do we use that Appendix B? Okay, I actually have the book. No, it's all right. We'll go over the table if either of you do not understand how to use that. Okay. So what we're going to do, we're going to use right now lump sum investment, and we'll try to calculate the future value. So let me show you. What we're going to do, we'll multiply the amount by the factor number. So there is this factor number that represents, let me show you an example, that represents this relationship between the periods, right? Either quarters, years, month, whatever that is, and a percent. Okay? So let's look how to, let me explain to you how to use this. So the table is based on interest rate and number of periods. As I said, let's invest $10,000. So we know it's 5 periods. That's given to us. We go down the table and we choose this 5 periods, 5 years. Okay, in our case, let's say it's a year. And then we also know it's a 6% rate. So we're going to go all the way to 6%. Okay? This is what we're going to use. This is the number that we will use. So the calculation that we're going to make is 10,000 multiplied by this number that we just found from the table. Does it make sense? You might have used that last semester. No, you haven't? All right. But the logic, something you've used, probably, right? This. So you take the initial investment and you multiply it by the number that you find from the periods and the percent. Okay? So at the intersection of those two is the number that you're going to multiply by the initial investment by that lump sum. Okay? All right? That's a lump sum investment. We're not paying by periods, right? It's not annuity. It's your lump sum. Yes?
I heard that different people put out different periods. Excuse me, put out different charts. They're not all the same. Sorry.
How different?
I've seen
Decimals?
I was told by some professors, don't go online and get a grid, get a chart. You have to only use mine. So let you know mine.
I don't see how can it be, probably the number of decimals may be different, but how can it be mathematically different? Right?
Check out my mind.
With this number 1.3382, it's your, if you look at this, so what is this number? That's your 1 multiplied by 101%. So how this can be any different? I'm just thinking it's a number of decimals that can be different. But it mathematically is just impossible, I'd say. Okay? So this 1.06, it's your 1 multiplied by 106%. Right? So, and it goes on and on, right? Okay. Okay. So just like we said, right? We just calculated this. 10,000 plus interest earned, that's your 13,383. You remember from the previous slide? The same calculation. But here, we just use the table, and we derive the same number. All right. So how do we apply the same concept for the annuities? Right? We also have annuities, okay? Annuity table that's similar to the one that we've just used. So for the annuity, our present value factors are the sum of the present value factors found in the present value for the dollar tables. What are those? When let me show you an example. So when we invest $2,000, right, at 6%, we pay. So it's installments, right? In fact, it's installments. At the end of each period, we pay $2,000 for the duration of five periods, and then somehow, let's look, how do we derive this? 11,274. Okay, we said that it's at 6%, investing $2,000 at the end of each year. So it does sound like an annuity. At the end of each period, we pay a set amount of money, and it's the same as the previous period. So let me show you how we calculated this. So we look at the 5 years, right? And then we go all the way to 6%. Do you see the numbers are different, right? It's a different table, right? So what we're going to do here, we'll take 2,000 initial investment, and we will multiply by that number that we find in the table. Now pay attention, this is not 10,000. Although during the whole period, we do invest $10,000, that's not what we're going to use with the table, right? We'll take initial investment of $2,000, and we'll multiply it by the future value of annuity factor, which in this case is 5.6371. So when you're using the table, you need to make sure you're using the correct one, right? So the previous table said future value factors, and that was for the lump sum. For the annuity, we're using future value of annuity factors. Okay, make sure you use the right one. All right. So let's go next. We talked about the future value. What about the present? So when we have a lump sum investment, we use, just by logic of it, a present value factor table. Here's how it looks. So here's what we're going to calculate right now. We want 13,383 to be received 5 periods from now at 6%. Okay, we want to calculate what is that present value of this amount in 5 years if we invested at 6%. My present value is what it would cost, what is the value of that amount today, right now, right? So how I'm going to use this table? I'm going to go all the way to 5 periods. and I'll go all the way to 6%. So what am I going to calculate right now? I'll take that 13,382 and I'll multiply it by this number that I found in the present value factors. All right? And that's going to give me 10,000. So here's, we calculated this. We said present value is my future value minus my interest earned, right? Less interest earned. Okay? So note which table you're using. You're using present value factors. Now that didn't confuse you. Now we're going to do that for the annuities. So here is, let's just think. Let's say you won the lottery. You have three options. You want to either the whole amount right now, you want a portion of it at the end of each year for 10 years, or you want 2,000 10 years from now. 2 million 10 years from now. So you have three options. You won the lottery, you just need to decide which one is better. Okay? So we're going to assume that our interest rate is 8%. Any of you think which one is better? No? Option 2. All right. Anyone else? Option 2. Why option 2? Ben?
Because I feel like it'll give you more money. Because for option 1, you're basically investing. Basically, you have an 8% on that 1 million, which will give you. It won't yield as much as the second option as you continue to grow as you get 15 each year. Because the technical present value of the first option is 1 million. When I did the math for the third option, it's only about 926,000. But the present value of the second option is valued at 1,066,500.
Nice. So you've done some calculations, not just a gut feeling. I'm glad to hear this. So let's look how we calculate. So we're going to use these present value factors, okay, for single sum and for annuities. So option 1 says that 1 million in your hand today. Okay, so that's what we have. Option 2 is 10 payments. So it's like our annuity, right? Annuity table we're going to use to calculate that present value. Okay? So we know that it's 6.7101 at 8% in 10 years. Okay, so we figure out what is our net present value? It's 1,006,515. So here we have option 2 is better than option 1, right? Great. So let's look. Oh, hold on. So let's look next. Option 3. Option 3 is our present value factors table, right? What we're going to take was we'll take that 2 million multiplied by whatever the factor we find, and now we see it's $926,400. Okay? So you're right. Option 2 is the one that we want to go with. Although if you just simply multiply it by the years, that might be a different number. Using your factor tables is actually going to give you what is that present value of whatever is offered. Right? Yeah.
The interest rate is they're taking away from the total amount. Interest rate is 8%, right?
Yeah.
Option 2, you did it as an annuity portion.
Yeah.
And interest rate each year. That gave you $1,006,515, right?
Yeah, so what I did, I used the present value of whatever that amount that's promised to me, right? So the option 2 said $150,000 at the end of each year for the next 10 years. So what I did, I calculated it with the annuity, table of annuity, right? So that gives me whatever is the present value today of whatever the years and whatever the percentage that's given to me. So at 8%, this is how much I'm going to get.
Well, I'm a little lost to this. How do you, if you're going to receive $2 million
Uh-huh.
10 years, it's 8% interest rate,
Yeah.
how are you going less than $2 million?
You're getting it in 10 years, right?
Okay.
That's your present value of $2 million in 10 years, given that it's 8% rate. That's your present value of the amount.
Okay.
All right. So that's not the end. We have some exercises, and we have not much time. Okay, let's try this. Look at this. Maybe, Pete, maybe that will help you. So your grandfather would like to share some of his fortune with you. Okay, similar. So what he offers is to give you money under one of the following scenarios. Very similar problem. Let's look at this. So the first one, he says that $8,750 is what you're going to get a year at the end of each of the next 7 years. Right? That's our annuity. And then $50,050 as a lump sum right now. And third option, $100,000, $250,000 as a lump sum in 7 years from now. So what you want to calculate is your present value of each scenario. So I'm giving you all the present value factors. We know that there is a 6% discount rate. And which scenario you want to calculate which scenario yields the highest present value. Okay? So let me show you, because we don't have a lot of time. Let me show you at least some of it. How would we calculate? So for right now, let's just do the first part of it. So we have 3 scenarios, like we said, right? So the first one, I'm going to use my annuity present value factor, and I'm giving it to you. All right? So he says that it's $8,750 per year for 7 years. So when I use my table, I find that my annuity is 5.582. So right now, if I were to get that amount right now, that would be $48,843. Okay? Your present value for the second one is given to you because he's giving that money right now. And he says, I'll give you $50,000, $50, yes, right now. So that's the present value. Now for the third scenario, so that we calculate, we know he said whatever, in 7 years you'll get $100,250. So to calculate that, I'm going to go into the table and I'll find that it's 0.665. Here I'm just giving it to you. Now if I were to get that scenario 3 at the end, right, that $100,250, right now the amount of money that I were to receive is $66,666. Interesting number. All right. So all of these things, what you are doing here, you're calculating what it would be right now in today's amount. All right. The first scenario is 48,843. Second is 50,050. And the third is 66,666. I would not go with the third one just because it's weird numbers. All right, so we're choosing the third one, obviously, right? All sixes. Cool. All right. All right, so what is the other part of this exercise? We want to see whether or not our calculations changing when we're talking about 12% discount rate. What do you think? Is it going to change? Yeah? All right. You don't think it's going to stay the same? Because all of it is going to change to 12%. Let's see. It's not. So the first scenario, we're going to use present value. When we calculate present value, we'll use the annuity PV factor, present value factor, and that's 4.564. So I'm going to multiply my, it's quiz time. So I'll multiply my amount by the annuity PV factor. For the second scenario, it's staying the same. And for the third, it's going to be in 7 years the amount that he promised multiplied by PV factor. And the amount is 45,313. So although the increase looks like it doubled, right? We just multiplied by 2 the percent. Don't make rash judgments. The numbers are not the same as you see, right? So we're going to go with the option 2. Okay, so 4 is next class.